Hello friends, welcome back to our lecture series on management accounting. Myself Aditya P. Tripathi, I am once again here with you to start our discussion on a very unique way of dealing with the topic of statement of cash flow. In today's lecture of mine, I'll tell you how to prepare a statement of cash flow for a case study based problem where you are not provided the information, like traditional way of asking a question where we were provided with a balance sheet of 2 consecutive periods and profit and loss account of that specific year to start with. In this situation, what happens as a manager, you are provided with a case study, with a problem based situation, and you are being asked to solve that problem. And eventually you realize that yes, for this specific type of problem, we have to solve a question, we have to prepare a statement of cash flow. So I would be telling you how to deal with a case based problem or case study based problem. In most of the B schools, we are not asking a direct question for this statement of cash flow when it comes to accounting for managerial decisions or management accounting. Rather, we are putting you in a situation, and a hypothetical situation is provided to you to deal with, and we ask you that how to solve a question of statement of cash flow. Now here comes two or three pertinent questions which most of my learners they ask me. First is, sir, how to deal with a situation where the balance sheet of only one period is given? Because there is a traditional learning, or there is a long established learning or understanding by most of the students from accounting or commerce background that in order to prepare statement of cash flow, the essential point is that we must have the balance sheet of 2 consecutive periods and the profit and loss account of current period along with some additional information. Now my counter question to those learners is that if I take your point to be correct, that yes, you need balance sheet of 2 consecutive periods, then what about a new company? Suppose if a company is completely new, entirely new, it has started its business this year only. So if I take up your assumption to be right, then obviously for this company we should not be in a position to prepare statement of cash flow. So are we going to write in the annual report of the company that we have not prepared statement of cash flow because this company is new, and for preparation of statement of cash flow, the presence of balance sheet of 2 periods is a prerequisite? Obviously it doesn't seem to be right answer. So remember, my dear learners, that normally you are provided with the balance sheet of 2 consecutive periods just to understand, just to sense the movement, just to sense the change in the value of those current assets, fixed assets, long-term liabilities and current liabilities. So if you recall my first very lecture of statement of cash flow, I told you that it is nothing but a kind of reanalysis or you can say segregated analysis of different components of balance sheet. Your balance sheet is showing the financial position of the company, but what about the cash position? So in order to know what is your cash position, that too in a classified manner, we have no other solution but to prepare statement of cash flow. So the first question of yours is that, sir, we should have the balance sheet of 2 consecutive periods, on compulsory basis, on mandatory basis for preparation of statement of cash flow. To this question, my answer is in negative. No, it's not compulsory that every time you would be provided with the balance sheet of 2 periods and profit and loss account of current period. There might be a possibility that we are only providing you the balance sheet of 1 year and expecting you to prepare statement of cash flow. There can be a situation. Or at times we don't provide you any balance sheet. At times we only provide you some extracts from the balance sheet and expect you to prepare statement of cash flow. So that can also be a situation. Now you must be thinking why this kind of gaming is being performed for the preparation of statement of cash flows. Because in practical life, when you start your career as a financial manager, you have to understand that there might be a possibility that you are not provided with you don't have access to profit and loss account and balance sheet of the company, and with the help of available information you have to sense the direction, composition and direction of data and make some judgment, make some decision, because you are going to emerge as a decision maker, and that decision which you have made will definitely be escalated to the top management for further action. So with this aptitude, with this idea, in today's lecture of mine, I'm going to tell you how to prepare statement of cash flow for a case-based problem. So first of all, I'll be showing you the extracts from the case study, what is there into that specific case. It's a caselet, it's not a complete case study, it's a small caselet where the income statement of a company called Budding Managers Limited for this year ending 31st March 2021 is given. So there is a company called Budding Entrepreneurs Limited, and it has provided you the income statement for this company on 31st March 2021. In the very first lecture of mine, I tried to just show you this case study. We didn't attempt it, we didn't solve it, because at that time we were not aware of the nitty-gritty of the procedure of preparing statement of cash flow. So this is the right time to discuss about this caselet, and I'll be telling you how to solve it, how to attempt it. If you look at this income statement, you have income, sales as income, and then you are showing the expenses: raw material consumed, general expenses, salary and wages, directors remuneration, and provision for bad and doubtful debts. And company has reported EBITDA, that is earning before interest, tax, depreciation and amortization, and this value comes to be 18,86,350. Why I am highlighting this value? Because we may start from this value also. We may start our journey of statement of cash flow with this value also. Because if you try to take up the value at an earlier stage, what will happen? You will not be subjected to more items, more number of nullifications. So you can avoid that, because if you look at this EBITDA, prior to this the deductions are out of all deductions, there is only one deduction, that is provision for bad and doubtful debt, which seem to be non-cash item. Other than that, everything else is an operating item, and it is in terms of cash unless otherwise mentioned. Let's proceed. What is there into the caselet? Then after that, they are showing you EBITDA. After this, we have provision for depreciation. So here, if we start with EBITDA, we can avoid the nullification of depreciation also. We have EBIT, interest on debentures, earning before tax, less provision for tax, and then we got earnings after tax, transfer to reserve, and surplus reported is 4,75,262. This is the detail about the profitability of this company called Budding Entrepreneurs Limited, and this is the way they have reported their profit and loss account. If you look at the balance sheet of the same company, they are showing you equity and liability, and then their long-term liabilities. Under equity, they have very simplified classification: share capital, general reserve, and surplus. The surplus is the same which you have got into, which have been reported into the profit and loss account, and you have got it from there only. Then we have loan funds, 10% debentures, current liabilities. Under that, you have accrued interest on debentures, trade payables, provision for income tax, and then the total. Obviously, it tallies because it is a balance sheet. After this, they are reporting non-current assets, current assets and non-current assets. Under non-current assets, they are reporting you the fixed assets minus depreciation. Then they have current assets, provision for BDD. From trade receivables, it has been deducted. Advance salary paid, advance income tax paid, cash in hand at bank, and then total. Now here in this balance sheet, we are provided with the cash in hand and at bank of rupees 37,850. This is nothing but my cash and cash equivalents at the end. Now there is a pertinent question in your mind: sir, what about the opening balance if I assume it to be closing balance? If there is no opening balance given, we shall make an assumption that the value must have been 0, because this is the very first year of company's operation, so the cash in hand might have been 0. In absence of any information, we cannot assume any value. So we will take up the value of 0, and do remember that 0 is also a value. So cash in hand at the beginning is 0 and closing balance is 37,850. So before starting my journey of preparation of statement of cash flow, I am very much aware that the sum total of cash flow from different activities must be equal to 37,850. So the beauty of this topic is that I am aware of the answer at the very outset, that the answer of my statement of cash flow should automatically come to be 37,850, which is nothing but my closing balance of cash and cash equivalent. So the aggregation of operating, investing and financing activity must give me the value of 37,850, given the situation where the opening balance of cash and cash equivalents is 0. Because since there is no other value given, I have assumed that I have asked you to assume that it should have been 0. Now comes the discussion. There is a person called Mr. Kushagra, who is the chairman of Budding Entrepreneurs Limited, which completed its first year of operation on 31st March 2021. And the CFO of the company, Ms. Hansa Kapoor, she is there in front of the chairman, and she is providing the excerpts from the conversation before the meeting of board of directors to propose a dividend for the current financial year. So they are on the table of discussion where they have to make a decision, they have to make a call that whether company should propose dividend or not, and if they are proposing, what should be the quantum of that dividend which company should pay. So in consultation with the CFO, chairman is going to propose that value, and let us see what chairman is speaking. Chairman said that he is really very glad to note that the company has made a profit of over 8,75,262 in the first very year. So the chairman is very happy that in the first very year of its operation, company has booked a very good amount of profit, which they might have expected, and it might have been as per their expectation. And the chairman says that I feel that we may declare a dividend of 5% to our equity shareholders. And here comes the answer of the CFO. CFO responds to this proposal that, sir, it had been a good year in terms of our financial performance, but the CFO is skeptical about the payment of dividend to the equity shareholders. Now imagine the company has booked a profit of rupees 8,75,262 in the very first year of its operations, and the chairman is willing to pay a dividend of 5%, declare a dividend of 5%, but CFO is saying that I'm very skeptical about the payment of dividend. Now here comes the statement of chairman in response to that of the CFO. Chairman does some rough calculation and says that if you make a calculation of 5%, if you do the calculation of 5% dividend on equity share capital value of rupees 44 lakh, it comes to be only rupees 2,20,000. And given the profit of 8,75,262, it is almost 1/4 of that value. So the chairman responds to the skeptical attitude or skeptical way of presenting the case of CFO with this data, with this figure, and asking a question that what is the problem? Why can't we pay dividend? And then the CFO responds that we have adequate book profit to pay the dividend, but the company is not having sufficient amount of cash. Company is running short of cash to pay dividend, and she is citing the closing balance of cash which is present in the balance sheet of the company, which is only 37,850. Which means that company has booked a good amount of profit, but the cash position of company is not that good. And it is the cash balance, the closing cash balance is equivalent to only 37,850. And here comes the counter reaction of chairman that he really failed to understand the accounting calculations of a CFO, which most of the non-commerce background managers, very often say that I really fail to understand such kind of calculation. Profit is there, but we can't pay dividend. Profit, cash, profit, what is the game? So if the profit of rupees 875,262 is there, then where is the cash lost? Where the cash is lost? And the moment you see this line in any of the case, let be very sure that it has to deal somewhere with the statement of cash flow. Because we are asking you to trace the cash, and wherever you have to find a technique which can which can help you in tracing the utilization of cash, you have no other technique but the statement of cash flow, which is there in place to assist you, to help you. So we have to find out now that where that cash is lost, where the cash has gone, and the CFO will definitely try to explain the cash position to the chairman. And now if you put yourself in the position of CFO, or if you take a request from CFO and CFO is seeking your advice as a person of management accounting, you have to give an advice to the CFO, then what should be the modus operandi? How to start? From where to start? So here, the moment you have to find the trace that cash, the utilization of cash, where the cash is lost, you should be reminded of the statement of cash flow. So we should now prepare statement of cash flow. So question has nowhere mentioned that you are required to prepare statement of cash flow. Question has simply put in front of you a problem faced by a discussion between the chairman and the CFO of a company, and then you are reported with the problem with which they are struggling for, and they are actually seeking your advice. So let us start with the preparation of statement of cash flow. Now, if you remember, I told you when I was showing you the profit and loss account of Budding Entrepreneurs Limited, I tried to show you that this is the point from where we can start, and that was the point of EBITDA, that is earning before interest, tax, depreciation and amortization, and exactly with the same value I have started. So first of all, I will be writing cash flow from operating activities, and here I have taken the value from profit and loss account of this Budding Entrepreneurs Limited, which reported earning before interest, tax, depreciation and amortization, and it is 18,86,350. Now you must be thinking, sir, why didn't you take earning before tax? Because normally you were taking earning before tax. Yes, we can start our journey from earning before tax also, but in that situation we might have to nullify the impact of depreciation as well, because this profit is before depreciation and amortization, and depreciation being a non-cash item, it need to be excluded from the cash flow, from the cash profit. That is why we nullify the impact of depreciation. So this is a deliberate attempt by of mine, just to show you that it is not compulsory that every time you have to add back the amount of depreciation. You will have to add it back only when you have subtracted it. You have taken a profit which is after subtracting that amount of depreciation. Since here we have started a journey from EBITDA, which is well before the amount of depreciation, so there is no point nullifying that, because it has never been part of this profit. In order to arrive at this profit of 18,86,350, we never subtracted amount of depreciation, and since depreciation was not subtracted, what is the point of adding it back? So we'll be taking up EBITDA, and then we shall have to nullify the impact of non-cash item. And if you cast your eyes at the profit and loss account, you will find only one item which can be called as non-cash item, and that is provision for bad and doubtful debts. So this provision for bad and doubtful debt with an amount of 73,500 comes to be a non-cash item, and since it was subtracted from the profit, it reduced the profit, which means that profit must be increased with this value. We have nullified its impact. Since it was subtracted, it will be added, and I have added 73,500 rupees on account of provision for bad and doubtful debt, and the sum total of this comes to be 19,59,850, and this is being called as operating profit before working capital changes. Now this point onwards, the interesting discussion will take place. I shall be discussing how we are going to deal with the working capital changes. So this is operating profit before working capital changes. After this, we'll have to work out for working capital changes. Now you must be thinking, sir, previously we were provided with a balance sheet of 2 years in a routine manner, and we were trying to witness the change in the value of current asset. We were taking some values of current asset like inventory, debtors, receivables and all, and we were trying to find the difference between the two, whether it has increased or decreased, and accordingly we were adding or subtracting. So do remember, here in this question we are only provided with the balance sheet of only 1 year. So some students say, sir, then this point can be skipped. Will we be skipping this point of working out with the working capital changes? Answer is no, because just like we have considered opening balance of cash to be 0, we shall follow the same path we shall follow the same logic for current asset and current liability as well. So do remember, all items of current assets and all items of current liabilities for the current year, they are present in the balance sheet. What about the previous value? We shall make an assumption that previous values must have been 0. Just like in case of cash balance, we made an assumption. So if we go with this logic, every component will witness increase, be it current asset or be it the current liability. So all items of current assets and current liabilities, they shall be considered to be increase in current assets and current liabilities respectively. So this is basically the point of understanding in this very case study. This is the point where I would like to draw your special attention, that whenever you deal with such kind of numerical problem where the balance sheet of only 1 year is provided, need not to bother about the working capital changes. You have to work on that step. You cannot skip that step, and you have to simply assume that the value is of increase. So we'll look at the balance sheet. On the liability side, we have only one item, that is trade payables, and we have assumed that there is an increase in current liability that will be added. And there is no other item of current asset. Why? Because there is no decrease in current asset. All items have recorded the value, the increase in value. Coming to the subtraction side, we have written for all current assets there is an increase. So all items of current asset, if you look, we have stock, we have trade receivables, we have advance salary. All items have been considered to be to have recorded the increase in their value, and what we have done, we have subtracted all these values. So that would actually be shown as negative, as cash outflow. We'll assume that cash must have been lost into it, because you have invested some money into stock, you have sold out goods on credit, you have paid some advance salary, so cash must have been lost. After working out with this addition and subtraction, what you will find? You will find operating profit of after working capital changes, which comes to be 8,59,850. And then I have to pay income tax. Income tax payment was given in the question, 2,75,000, and this is resulting into the cash generation from operating activity, and I found the net cash generated from operating activities to be 5,84,850. So my dear learners, in this very question, at this step of cash flow from operating activities, I tried to explain you how to deal with the working capital changes. Because if you don't find the balance sheet of 2 periods, then definitely you are very much worried about, your point of concern is about the change in the value of current asset and current liability. Need not to bother about that. Assume the previous value to be 0, and in that situation what will happen? Every item of current asset and current liability shall be assumed to have increase in their value, and accordingly the treatment will take place. After this, we'll have to go for investing activity. The same logic shall apply for assets also. Investing activity means whatever investment you have made in terms of your fixed assets. So you have purchased some fixed assets. All fixed assets shall be assumed that previous value might have been 0 and there must have been purchase. But do remember that depreciation you have to exclude out of it. So the value of fixed assets shall be considered to be a purchase of fixed assets, 73,22,000. It was given in the balance sheet. We have assumed that this is a cash outflow due to purchase of fixed assets. So there is no other item reported in the question. I would write cash used in investing activity. We have invested 73,22,000 rupees under this activity. Now the third activity is cash flow from financing activity. All non-current liabilities will find place here under financing activity. Issue of equity shares, we'll assume that there was no previous equity value, so entire amount of 44 lakh results into the cash inflow. Issue of debentures, 25 lakh, again the cash inflow. Interest on debentures, remember only the payment part shall be considered. If you recall the question, 2,50,000 rupees of interest on debentures was due, but the company only made payment of 1,25,000, which shall be shown as cash outflow. So if you look at the net amount of rupees 67,75,000 comes as cash generation from financing activities. And after this, what we'll do, we'll aggregate, just like we have been doing in previous question. We'll have to aggregate cash flow from different activities, A plus B plus C, and here we find the value of 37,850 to be positive, and opening balance of cash was 0, so closing balance of cash shall automatically become 37,850. So in this way, my dear learners, the moment you prepare the statement of cash flow, you find an answer to your question where the cash has gone. Now you can straight away say that the company has generated cash under the operating activities with an amount of 5,84,850, Under investing activity, company has recorded, witnessed an outflow. So cash, major part of cash has been used into this activity, 73,22,000. And again, you have generated cash from financing activities with an amount of 67,75,000. So in this way, my dear learners, we could find the answer to this question where the cash has gone. And after that, you can simply write a statement that yes, this is the way we have found the traceability of this situation. We could trace the utilization of cash. You can report that yes, the cash has gone into these activities in this manner. So with this, my dear learners, I tried to put in front of you a case-based problem of statement of cash flow, which is very unique in nature, and at times you come across such kind of questions in the exam. I hope now you will be in a position to solve these kind of questions as well. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.